Hello everyone, it's Craig Larson from Larson Financial Advisors with our market message for April 15th, 2013. As you can see, I'm casual and wearing black today because, number one, it's tax filing day. So it's not really any fun to have to work on taxes and to write those checks. And also, I'm going to scroll over so you can see out the window. Here in Minneapolis, we still have significant snowfall and are about 20 degrees below the average seasonal highs for this time of year. Now, since it's tax filing deadline, I thought it'd be fun to just do a quick tax rant and give you some facts and figures. And this is a bipartisan tax rant. We're not blaming either political party, but rather both of them for the financial mess that we're in. Number one, Tax Freedom Day, which is the day that we need to work up to on the calendar to fully pay our taxes, is April 18th this year. So we've got until Thursday that we're still working for the government. And that was 5 days longer than it was last year. Last year's Tax Freedom Day was the 13th. So we're working 5 extra days for Uncle Sam this year, unfortunately. Secondly, I read a great commentary by John Malden, who's one of my favorite financial authors and analysts, who carefully reviewed the budget proposal that Obama is working on right now, and some of the assumptions that the CBO, or the Congressional Budget Office, uses as they develop these. Number one, they were assuming that there would be no recessions at all for the next 10 years, when in fact that's never happened in our entire history. And usually, in fact, in any 10-year period, there's 2 recessions. Secondly, they are assuming that there will be a period of GDP growth 4% per year for 3 years, when in fact the last time that happened was the 1960s. In fact, you have to go back to the 1960s to find 1 year with greater than 4% GDP growth in this country. And finally, these are the same people that brought us the brilliance of the projections on the healthcare bill, which was put into place 2 years ago and is now actually costing 40% more than what was forecast just 2 years ago. So I quite frankly think these people are living on a different planet, but there's not really much I can do about it. So I'm going to stop my tax rant. We'll move on to markets now. Right now, year to date, U.S. stocks has been the place to be in growth markets. The U.S. market, as tracked by the S&P 500, is up about 8.5–9% year to date now, and international markets, most of them at least, are flat to negative for the year. Bonds are about flat for the year, and commodity markets are down. In fact, today, down significantly. Both oil and copper and gold especially are taking big hits today, and gold got slammed pretty good last week too, on rumors that the Cyprus Central Bank may have to liquidate all of their gold holdings to get cash to pay for their big financial mess that they're in. So the market's worried about Spain and Italy and Portugal having to do the same thing. It's really ruffling up the gold market right now. So the place to have been is stocks. Right now, U.S. stocks are in the number 1 top relative strength position on our rankings, international number 2. Commodities are way down at the bottom, number 6 out of 6. So if you do have money in markets right now, make sure that you have your risk management plan in place as we approach the seasonally weak time in stock markets, which is May 1st through October. And if you have money on the sidelines, it'd still be prudent to wait for a good entry point. Right now, the market's a bit overextended. It's about 9% above its 200-day moving average, which would suggest statistically that it's due for a pullback. And quite frankly, I think that in the weeks and months ahead, we're going to get a much better entry point into stocks. So we will keep you posted. Thank you for tuning in, and have a great day.